All right.
Mute myself.
All right, everybody. Happy Friday. Happy trading day. See what was going on today. We got markets down a little bit. Some of the stocks that I talked to you guys about on the audio room every day, Nvidia, Tesla. Not too much to report on, but happy trading day nonetheless. Welcome to today's webinar. This one is actually going to be, I think, my favorite one. The title is Sophisticated Stock and Bond Portfolio Management. However, it goes a little bit further than that because I'm going to be talking about sophisticated stock and bond portfolio management for 2024. How interest rates coming down, according to the Fed, sometime in June, are going to impact your decisions when creating investments. So, without further ado, I'm going to go ahead and get started. Might want to get your notes out for this. This one is going to be full of information that you're going to want to hear about. So, in 2023, amid rising interest rates and wild swings in market sentiment, as you know, 2023 was extremely volatile. Many investors flocked to money market funds. Last year alone, pouring more than $1 trillion and in total, it's about $6 trillion. So, however, the US Federal Reserve is now talking about cutting the high interest rates that made those money market funds appealing, and the landscape has started to shift. Those money market funds were yielding 5.5%, CDs, 1, 2, 3 years, the same. Okay, the stock market has broadened, but cannot be counted on to deliver smoothly, uh, even perform across sectors, factors, or market capitalizations. Parts of the bond market feature attractive valuations not seen in more than a decade. And consequently, the independent investment teams that I work with, that we work with at Raymond James, you see my banner here. We expect capital markets to offer select opportunities in 2024, ones that are going to be similar, if not higher yielding than the money markets that our clients and so many investors have been in the past couple of years. So we're going to see opportunities in high quality small cap stocks, dividend paying stocks, and longer duration fixed income securities. So last year, money market funds temporarily offered attractive yields relative to recent history, but they're not long-term investments. Money markets are meant to be held in the short term. They are a short-term solution for investors looking to capitalize on heightened opportunities and evolving landscape. Now could be the time to build a more diversified portfolio, focused on the long term. Okay, as per what the title of this webinar is. So, following the global financial crisis, investors had the pleasure of being in a market environment that was abundantly constructive for equity returns. Okay, interest rates were low and fueled by the growth at any price model that dominated for nearly a decade, since 2008 or so. The COVID-19 pandemic further fueled this model while elevating macroeconomic uncertainty, which led to more rapid shifts in the narrative. And we watched as the market decimated travel and leisure companies when everyone felt the world was ending amid lockdowns and until it didn't. And coming out of the pandemic, office real estate valuations got decimated when it wasn't expected that everyone would, or when it was expected that everyone would work from home forever until they didn't. Since the release of ChatGPT and a generative AI model, we've seen companies associated with AI markedly outperform. And similarly, the GLP-1, the weight loss drugs like Ozempic and yada yada, have taken the market by storm. And we've seen fast food companies and stable snack marketers, I'm sorry, makers, get unreasonably discounted. This uncertain and fickle market has encouraged a record amount of money to move onto the sidelines while also creating dislocations in equity markets as investors flocked to the perceived safety of the large companies, right? In 2023, investors move to money market funds and brought their total asset base to more than with the money market total asset base to $6 trillion, like I mentioned before. And meanwhile, the Fed has locked horns with inflation for almost 2 years now. We've been talking about inflation going up and going up and going up. And then when is it going to be coming back down? Interest rates have been a bumpy ride. With all eyes on the Fed, it's calculus for determining whether to pause, raise, or lower the rates. The market has attempted to glean what the next rate decision might be with every data release. The Fed governor's speech and FOMC meetings. And immediately after October's CPI showed inflation below estimates, the futures market went from pricing in 3 rate cuts to pricing in 4 rate cuts by the end of 2024. And what I mean by pricing in is that the markets will take into account that these rate cuts have already happened. Okay. And now at the peak of the rate hiking cycle, portfolio teams, investment managers believe investors need to have a plan for redeploying capital before market movements leave them behind. Might be too late eventually. Who knows? The market's snap reactions to new data create a myriad of opportunities for investors and active managers who have the capacity to stay engaged with and inspect the market's priced in and chosen narratives. And don't sit out and miss out. Timing the market always beats timing the markets. No matter what, timing the market, not timing the market. So focusing on the micro, fading the macro. So market breadth has been terrible until very recently. While the S&P index returned 26%-ish in 2023, I think it was, don't quote me, 26-ish%, I think. The S&P 500 equal weight index returned an unimpressive 13.8%. If you didn't own the last year's big mega cap winners, your portfolio was left in the dust as the 7 largest stocks ballooned to make about 30% of the S&P 500 index, completely dominating its return profile. And at the same time, the underperformance of the Russell 2000 small cap index to the tech-dominated NASDAQ composite index marked a historically large dislocation in the market. Big outperformed small, growth outperformed value, and domestic outperformed international, and with great consistency, I might add. But it hasn't always been like this. Looking forward and starting from such high valuations, it feels increasingly unlikely that breadth will expand so rapidly that most sectors, factors, and geographies will move up in unison. So in this environment, small cap stocks feature attractive valuations and a history of strong performance in previous post-rate hike cycles. Dividend-paying stocks likewise have provided downside protection and upside performance compared with the broader equity market following past rate hike cycles. And then long duration bonds typically offer higher yields and fixed interest payments over extended periods than money markets. Plus the potential for capital appreciation when interest rates decline because of the inverse relationship. We've talked about that in previous webinars. So with that said, I'm going to start out with what I have to say about the performance of equities, particularly small caps and dividend payers. So there's this notion called getting paid to wait. It's a phrase with 2 meanings pretty much. So one older and one newer. Unfortunately, it's the newer usage, the one that's become synonymous with leaving cash on the sidelines, that arguably exerts inordinate and unproductive influence on many investors today. So after an uncertain 2023, the independent equity investment teams across every major broker-dealer believe that 2024 is the time to move the paid-to-wait discussion back to the original meeting while focusing on the benefits of dividend-paying stocks. And by returning cash to shareholders, dividends provide investors with an incentive to stay invested, even in uncertain market environments. So we've gone over dividends in the past. They're a way for companies to reward shareholders for being a shareholder. Okay. we also are going to, along with dividend payers, we're going to be considering small cap stocks, which have attractive valuations, posted competitive performance in previous post-rate hike environments, and have started 2024 well below their all-time highs, even after posting the strongest December on record. Well, how we got here right now in 2024 is well known. Uncertainty brings anxiety. There's no doubt that the equity markets last year were whipsawed by uncertainty, they say, to say the least. But is the U.S. Federal Reserve done hiking rates? Will there be a recession in 2024? Will AI take all our jobs? Faced with high interest rates, unknown risk, and market volatility, more and more investors leaned into short-term money markets. Like I said before, $6 trillion worth of, and that for a time offered attractive yields relative to recent history. Before a couple of years ago, no one could find anything in the fixed income space that was yielding 5%, especially cash. So household bank deposits also swelled nearly $4 trillion as of the third quarter of 2023, according to the Federal Reserve Bank of St. Louis. And many of these investors opted to get paid to wait in money market funds. Okay, these yields, however, they're not going to last forever. So eventually that money will need to come off the sidelines and get redeployed into the market. It's not going to be 5% forever. There's no way that the banks can keep up with that. So now the question is, where do we go from here? While small caps and dividend payers have had a rough go recently and might be top of mind, the economic backdrop today could bode well for returns in each if history is any indication. We like to say history is not an indication of future performance, but we can use it as a guideline, right? So to start with small cap stocks, small cap stocks typically representing companies with market caps ranging between 300 million and 2 billion. They're known for their potential for high growth. Okay, they can be nimble, often more domestically focused. They can respond quickly to economic changes, which makes them well positioned in the investment world. But two key reasons to look at this area of the market are small caps, attractive relative valuations, and historic performance following monetary policy cycles, as we're experiencing right now, right? So current relative valuations, when compared to historic trends, paint a potentially opportunistic picture for small caps as we are approaching some of the most attractive valuation levels going back to the early 2000s, before I was in the industry, of course. And if there is one takeaway to the relative attractiveness of small caps to large caps right now, it is that the market capitalization of the single largest stock in the S&P 500 index is larger than the entire market cap of the Russell 2000 index. Okay. Additionally, looking at the current economic environment and potential Fed actions, if we are closer than ever to the peak of the rate hiking cycle, with rate cuts ultimately to follow, it is worthwhile to pay attention to the smaller market cap range of stocks. Even if posting its strongest December on record to close in 2023, the Russell 2000, which is the small cap index, entered the new year still 17% below its all-time highs in November 2021. Now, earnings growth is starting to inflect, and a more benign economic backdrop can propel earnings momentum and margin expansion in 2024. Investor positioning is also very light, so increased flows to the asset class could also help the rally to continue. Okay, so that's for small caps. Very bullish on small caps. This is the time to buy. If you're not going to buy individual small cap companies, buy small cap ETFs or mutual funds if you have to, but mostly ETFs. Now, before I get into dividend payers, so there is within the S&P 500, there's an index called the S&P 500 Dividend Aristocrats Index. I've spoken about this in the past, maybe on audio rooms, but it measures the performance of the S&P 500 companies that have increased dividends year after year for the last 25 consecutive years. So as in fixed income, interest rates are the key driver of returns in these securities. Okay. So this is another area of note within equity markets. When looking forward to what many project to be falling rate environment, is dividend paying equity, specifically dividend growers. In 2023 was not kind to this asset class whatsoever. It is important to understand that interest rates are going to be a key driver of returns for these securities in a similar fashion to fixed income. Okay, they're interest rate sensitive. When the interest rate comes down, the value of them is going to go up. So I had this chart in front of me. It shows the following rate environments tend to be difficult for equities as the Federal Reserve cuts rates into a tough economic environment, but have provided a level of downside risk mitigation in dividend growing equities as represented by the S&P 500 Dividend Aristocrat Index, have provided upside over longer time frames. So I have this quote in front of me as well. Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. Powerful. Some investors inevitably ask, why not just get paid to wait in cash until there is more clarity as to what's next for the capital markets? Fair, but if history is any indication, markets can move at a speed that makes it a brutal, near impossible task to time them effectively. Studies have shown that just missing out on the 5, 10, or 20 best days of the market over a 20 or 30-year period significantly reduce the return potential of an investment. Okay. When the market reverses, it tends to do so abruptly and often in the face of extreme adversity and volatility. So waiting for a sign to get back into the equity market may leave you watching the game pass by you. As renowned fund manager Peter Lynch said of market timing, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. I'm going to keep that quote. It's a fantastic quote. So current economic environment coupled with the historical performance trends following the Fed rate hike cycles and relative valuations make a strong case for considering these investments. For those sitting in cash, the investment teams believe that moving into small caps and or dividend paying equities should be a strategic decision that sets the stage for robust long-term returns through a balance of potential growth, portfolio diversification, and downside risk mitigation. So absolutely now is a time to buy. And now I'm going to go over long duration bonds. With short-term investment vehicles advertising temporary yields of more than 5%, 2023 was a banner year for money market funds, with total fund assets topping $6 trillion, as I mentioned before. And in uncertain markets, allocations to cash and cash equivalents is absolutely prudent. We recommend that in times of uncertain markets, especially if your time horizon isn't quite as long as others. In December, however, the U.S. Federal Reserve signaled that the record acceleration of monetary policy in 2022 and 2023 might have reached its peak, opening the door to possible interest rate cuts in 2024. In a falling rate environment, the portfolio teams all over the place and investment managers believe that the money market instruments of 2023 are no longer in the best interests of long-term investors. Instead, they see 2024 as the time to consider making the switch into more traditional implementations of fixed income, in particular long duration bonds, before rates begin to fall. Okay. How do you go about choosing the right vehicle for the environment? Okay, valid. Higher rates are more profitable for fixed income investors, but they usually come at the end of the Fed rate hiking cycle, typically followed by rate cuts. Okay, the short-term treasury bills and their certificates of deposits largely held by money market funds have two weaknesses in the interest rate environment. Okay, weakness number one, short-dated instruments have limited room for capital appreciation, which restrict their ability to benefit from the inverse relationship between bond prices and interest rates. Okay, the interest the rates of interest offered by money market instruments reset at the end of each term, meaning that they usually follow overall interest rates downward. Okay, and in a more normalized environment, their lower yields pale in comparison to the returns of long-term bonds or other instruments that are intended to be investment assets. Okay. Duration bonds, such as treasury bonds or corporate bonds, typically offer higher yields and fixed interest payments over an extended period. When interest rates decline, the value of existing bonds tend to rise, giving bondholders the potential to benefit from capital appreciation, very seldom seen. I was told that, and before I was in the business, the last time they've seen a total return in bonds was, over a decade ago. Owning bonds with duration rather than money market instruments provides a tailwind to long-term investors in a falling interest rate environment, in the view of the independent investment managers across the industry. Money market rates may be attractive for the short term, but they ultimately do not serve the long-term investor. When investing in these shorter term instruments, it's important to note that these rates are inherently promised for a short term and are reset at the end of the term. Money markets can adjust their interest rate without even telling you. Okay. Investing in longer term bonds allows for the yield to be earned over the life of those bonds, assuming there are no credit events, which is why investors seeking reliable income streams over the long run tend to prefer high grade credits. We would never, ever sell a client a bond that is nothing less than completely investment grade. So ultimately, while money markets can be used to supplement short-term cash needs, they are not investments, bottom line. In today's environment, portfolio teams around the country and investment managers see long-term duration bonds as very attractive at yields currently available, and we're sacrificing short-term yields for longer-term ending values. In conclusion for today's webinar, buy dividend-paying stocks, buy ETFs that are invested in the S&P 500 Aristocrats Dividend Index, buy small caps. If you don't want to buy individual small caps, buy small cap ETFs, buy small cap mutual funds, buy long duration bonds. Okay, long duration bonds go out for many years. Lock in for many years at the rates that they are now. They're not going to be like this forever. Money markets and CDs are not investments. They are short-term solutions to supplement short-term cash needs. If there's anything that you guys need, reach out to me on Instagram at the Wes Gottesman or on TradeZing at Wes. I hope you enjoyed today's webinar. And I tried to pack as much as I could in. But if there's anything that you guys need, you just let me know. I hope you have a wonderful rest of the day and a great weekend. Stay safe out there, and we'll see you later. Bye-bye, everybody.